Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you our strategy of the week update here for June 1st, starting off the week and the month. Well, starting off our weekly update, I should say, on the first of a month. A rarity, but a nice surprise because as a seasonal or technical trader, I oftentimes look to the first of the month to potentially be kind of an inflection point, right? And this first happens to also be the start of a new quarter, and all those good things are getting us halfway through a year and what have you. So, all right, well, with all that being said, remember trading futures involves risk and is not suitable for all investors. And everything I talk about here today is just my own opinion and not a direct trade recommendation. But today we have some interesting price dynamics to talk about in the row crops in particular. Agricultural futures today, pretty much across the board, finishing green. You really had to scrape the barrel to try to find where there was some red on the board. July corn there, not sure if the settlement came out. We were down a penny and a half on the day, but we didn't quite squeak out a positive day for July corn either. One of those, kind of the odd what do you call it? The odd markets out, right, across today. And actually, I think it was canola I was watching earlier today. Yeah, and they actually closed positive too. So canola oil was negative, where bean oil was positive. Another kind of weird dynamic, but as we'll look at in a little bit when we get into the oil complex, we'll look at how those three, canola, palm, and soy oil, have maybe flipped and turned coming out of very oversold conditions. I want to begin today, though, by talking about the U.S. dollar, and then we'll back our way into the row crops because, we were having discussions, kind of playing devil's advocate, right? Things turned a little bullish on the day, or, the last 2 days for row crops. We know that there's some tailwind, but not tailwind. There's issues down the road with the balance sheet that we'll have to eventually talk about in terms of demand that was added in year over year for corn. If it's not there, our balance sheet looks a lot thicker than it already is suggesting, right? And we were, talking about the dollar in terms of when we consider it in terms of a basket against other currencies in the index. We're trading at considerably higher U.S. dollar value, a stronger dollar compared to, other years that we've been comparing this crop year and this market to, like 2012 through 2015. Let's just take that, era coming out of that recession in 2008 through 2010. Globally, the world was coming back online from, generally a financial and debt crisis that affected everyone everywhere. As the world started churning again, right, and demand for everything picked up. 2013 through 2015, reasonably good production years in terms of row crops, certainly saw a saturated export market. And we also saw this very weak U.S. dollar. So there is, very strong, in terms of the long-term valuation of the dollar, there's a very strong pull on commodities back when the dollar was very weak like that. Just because, hey, the dollar, or the purchasing power, rather, I should say, with a weaker dollar, right, helps our export partners be able to afford more of those commodities. Well, in times of plenty, that obviously helped demand. Well, the dollar's considerably stronger now, right? It's considerably more expensive for somebody to buy U.S. dollars with their, Chinese yuan, to then buy soybeans or pork or whatever else, whatever other commodity we want to talk about. But the idea being, and corn included, right? The idea being is that there's now, 20, 30% higher U.S. dollar compared to where it was back then 10 years ago, when we're, another market that we're comparing, this production cycle, to coming out of tight balance, coming out of tight carryout and balance sheets and going into, right, maybe, buffer or bumper and bumper crop years and building those balance sheets back out. But that all needs to happen, right? And for right now, while a falling U.S. dollar could change that script, and certainly, you've heard me talk about the reversal in this blow-off top that we saw running back up above 100, coming back down during the inflationary, period for most of our commodities, by the way. So there was definitely a rush to buy U.S. dollars to buy commodities, I think is the idea. But now those, that trend is reversing. Well, the further down the U.S. dollar goes, the more purchasing power those, abroad carries to get at those exports. And so falling back below 100, going back into our old range, we end up, right, maybe with reversing that trend a little bit. So that's something we're watching closely, right? That kind of negates that headwind that could be, trailing us here towards the end of the year. In the export market and hitting that demand. And that's where, we think, generally speaking, at least on the balance sheet, corn demand could come into question, right? But interesting take, as we compare these crop years and everything else, let's also compare, right? If we're comparing the 2013 chart like that so many have, and actually it's spot on with 2013 in terms of what, corn and beans did at that point. We saw a rally at this almost like on the dot with what we were seeing in terms of, I guess it was within a week, right, of what we saw in those charts. But the point being is that there was still a seasonal weather scare. There's a reason to build some premium back into the charts. And then there was a reason to take that premium back out, once rains finally came. And so let's shift the gears before we get into the actual row crop charts and just kind of talk about where we are in terms of weather, current forecasts, and what in the last 24 hours has changed that actually was probably a pretty determining factor on why we saw follow through. Yesterday, coming off of like the 1270 area on soybeans, coming back up to test $13, that's just like broken support, now is resistance. If you want to talk about auction theory, that's just a market discovering price intraday, right? Going back above $13 with a headline about a drought, certainly that's more effective to corn, but it's going to affect beans too, and wheat to the same effect, right? Dryness is dryness. It affects yields pretty communally. The follow through we saw was probably right in reaction to now confirmation that fundamental shift might be happening in weather. If the technicals are popping off, right, then funds have a reason to cover, and the short that has built up in the market, because we've just been so heavily leaned into for so long, that short starts to cover and get out. So one thing to note is temperature forecasts over the next week, popping up and seeing those 9s as far north as South Dakota, 90s sweeping across most of the Corn Belt. Not great when we've been dry for many of these areas, and the forecasts aren't looking so great, right? So warming up, like, not getting that warm, right, doesn't dry things out as much. Preaching to the choir, we all know where temperature can lead. Not seeing that build up in the southern Gulf, still seeing that eastern westerly jet stream sweeping moisture from the Gulf out across the Atlantic. Hurricane season, so to speak, hasn't started. Any of these tropical depressions building out over the Atlantic, none of them are making their way towards the Caribbean at this time. That could shift, and if it does, and it starts sucking that moisture up, basically reverse up the Mississippi and across the U.S., that's the great rain bringer, right? If we saw that type of storm building and coming in over the next week or two, that could be, something to talk about. And certainly there's some depressions out here that could become something, but they're fighting, they're fighting the jet streams to get to where we would want them. So this point in the season, we can't count on some of those bigger factors that we look at. Across the U.S., the last few days we've seen some spattered rains in the I-states. Most of that rain and precipitation that's been falling has been in that south east, alleviating some of the drought conditions that we've already seen down there. And if you look at the drought maps and what the forecasted drought monitors are saying, you can see where that's, generally where the improvement is happening. Okay, that's great. But the worrisome thing is, the eastern and western corn belt and really the heartland for corn production that needs some rain. And the rain we certainly got in the last 24 hours, everyone I've talked to, and certainly my own anecdotal experience of what we saw was places that got rain, quarter to half an inch for 30 minutes, real quick, big douse, but it was sporadic and wasn't everywhere. 6 to 10 day forecast. This map has almost not changed. I mean, there's been subtle differences in where the brown, gray, and green areas have been for the last several weeks. I keep kind of coming back to the rains that are these near normal and this below area that keeps spreading and getting bigger, and rains that just don't come. The 8 to 14 day forecast still looks like very good. It has almost never not looked good. Which is frustrating because it's like once we get a week out, it's almost like models are acknowledging the dry conditions and they're slowly shifting after being very, very, honestly, very wet for most of the early season. I mean, we were expecting very high El Nino conditions, which would bring a lot of rain from the almanac reading that I've done. That does not seem to be the case. And I think the conversation has shifted, and I haven't heard anyone say El Nino in a couple weeks now, which is kind of interesting, right? Where did that go? Temperature outlooks, they look very bizarre for this time of year for me. You don't normally see below normal temperatures out west. Usually, last year, I think this time we had a big old heat dome out there that was building. But it stinks to see this above average temperature in our main growing pockets. It's like the desert is cool and the grasslands in our plains are warm. Not at all a good look to what we want to see. And the actual precipitation of the last couple weeks, or last day and week now, this is just the last 24 hours. So you can see in kind of my neck of the woods, that half an inch to an inch, it says, of range, but if you notice that inch of rain didn't fall until you almost got on top of the city of Chicago. I can tell you where this rain fell, where we're reading an inch of rain here. There is little to no growing of any agricultural product over here. So it rained on a major metropolitan area, which is kind of funny to think about, right? The Board of Trade got rained on while the rest of Illinois didn't get any rain from what the map kind of says for the rest of yesterday. Take that with a grain of salt, but this precipitation of the last week, when you take that bigger step back and look at kind of the heat map, so to speak, of the country, it is pretty clear where rain has not fallen. It's like just follow the Mississippi until you get to Minnesota, and we got some precipitation up there, but just about everywhere within a few hundred miles of the Mississippi was incredibly dry this last week. And you can see, with the exception of a little belt of precipitation through Indiana, the eastern corn belt was also very dry. And it's just like the Great Lake region all the way through Iowa and into Missouri and has been without rain this last week. And if it doesn't come into over the next 2 weeks, there's a big reason why these drought maps are starting to shift. So this drought map, coupled with, I think, this drought outlook for the next month, big reasons why we saw that follow through today. And I think there's more talk, and there's, if there was any reason to cover shorts, there has been a palpable bid in the market for corn, wheat, and beans in the last 24 hours. We're well off the lows, but today we finished off of highs, and markets don't go straight up, even in short covering rallies. There's always some push and pull and fight over trend, but The shift here, seeing the improving conditions in the Southwest, okay, well, that's not hard to predict. We're literally getting rain there in the last 48 hours. Things are, in theory, improving there already, so that's great. The concerning portion is the acknowledgement that drought is likely developing through the I-states and pretty much just in the Corn Belt, East and West included, right? That is not a great look for the monthly outlook. That's a big shift and an acknowledgement, but that could also be this forecasting model shifting and acknowledging the drier conditions we've seen. For whatever reason, if all of a sudden this model, which was generally speaking calling for pretty much perfect conditions, this is the NOAA and GFS model over the last several months, which just hasn't come to fruition, it's shifting, right, its model to account for this dryness, right? The drought map a week ago showed Illinois and our I-states getting a little flustered, right? The change over the last week has really, really shown and that growth. Into next week, without rain or without, and a shift here, and this gets redder, I think we all know how the market can react. So let's now hop into price action, knowing that we have, if there was, a couple weeks ago built up in the market the most bullish or bearish, weather news, we've kind of shifted that pendulum, right? If weather was a bullish, bearish kind of psychological thing to look at or consider, the pendulum has swung now in terms of forecast to really go the other way. So if news and headlines are shifting, if the charts have shifted their technical setups or what have you, there could be a good reason to think this short covering rally could get legs, and it's good now to start considering how high can it go. Can you be a part of it with re-ownership or getting long? Is it a reason, right? Have we seen enough of a reversal of a trend to buy into it? And then lastly, how can we structure and plan for sales on the way back up for producers? Let's start with November beans. Daily chart is up in front of, or July beans, excuse me. Daily chart's up in front of me. Closed the day up 29 3/4 cents. That was a very good close, back above the 10-day moving average. The last 48 hours look like capitulation, but we're still not above the highs that we fell from, right? Basically 70 cents from. We're still not back above that level. So yes, this was good recovery, but this just gets us back to the range we were in for the last 2 weeks of May and into the end of the month. So as much as I want to say that, July beans have reversed the trend and what have you, we need to see the follow through now. And ideally, back above 1353, that 18-day moving average would be another good, short-term indication that it's probably, getting into something. There is a technical setup. The selling pressure on the way down for beans has actually been quite technical. Last week, we talked about 1450. There was that 50% from the $15 high to low that Hague, had held. It's also where the 18-day moving average was. The market rolled over, it went through lows and went beyond where technically, those sellers would have been looking for potential profit targets around 1350 is the idea. We went below those levels. So now there's another way to gauge if this trend is continuing lower or not on the short time frame. We'll look at that in just a minute. But I want to take a step back and reflect where this 1270 low was or happened from, because if you look back on the July chart, it's basically just a retest of the range that we were in the end of 2021. We're pulling back to, and if you consider the continuation chart for soybeans, and in 2021, you can see here, it's a test back to basically the supportive area from that time frame, right? And $13, of course, just beans in the teens in general as a psychological level. All right, so let's take a look at Novi beans real quick because they too recovered the day, but again, still below their 10-day moving average there, and still actually below kind of the low end of that consolidative range I talked about the last 2 weeks of May. So recovery is great, but still, is this just a dead cat bounce? Novi beans, I don't see any reason why, like in a recovery, we couldn't get back towards 1250 to 1260. I think that's a good area to think about, sales. If you haven't, well, I think you could think about them before then too, but I think that's like the top end of a place to really consider if we get back there. If you haven't done anything for, you do something kind of idea. But we will, of course, be tracking the trend, I think, up into that area, because there could be reasons to sit on the sidelines, but that would require not only us seeing a technical trend on the chart continuing, but would also at this point to not do sales on the way back up. We would need to see a really, really bullish technical chart and a clear trend that we can identify and track, right, from a technical perspective. And we would need to see just continual headline after headline after headline of no rain coming. Like every day you'd have to wake up and see, the world not getting a drink. And not to say that can't happen. It's just, if history tells you anything, it's the most unlikely situation. Statistically speaking, right, we don't have major crop loss years or major weather events. Statistically speaking, we produce a crop every year, more times than not, right? But so far, right, if you track the climate, the weather footprints in the sand, if you've tracked the trend lines in the sand, there's good indication that there is a period here where that could start. And that risk-taking, that's the big question here. Soybeans, have we reversed the technicals on the chart? No. I can't sit here and say we have. I think it's a good intraday, 2-day reversal, but it hasn't technically really made any progress higher because 2 days ago, right, we were falling down below these levels. Don't get me wrong. I think that this is a great start to a V-shaped recovery. And I think the progress into the end of this week is going to tell us a lot. The next few days of soybeans will tell you a lot. And if, maybe waiting for even missing out on a few of those pennies now, and then waiting for a little bit of a pullback, because there's usually one, is probably the name of the game. But call spreads, I think there's still opportunities there. But you have to, again, if you're selling a call, alongside buying one, you're kind of planning on being wrong to a certain extent, but that's part of the strategy because you acknowledge that there might be a period where that short call gives us protection, and that's okay because that's risk management 101, right? You don't always need to swing a big bat. Okay, so on the Novi beans, we have pulled back to test that kind of basically the breakout area. At the end of 2021, it was the resistance here at $12. We've come down to test it. We've gone below. Is this the capitulation that brings us back above? Novi beans have a lot of chewing to do. We'll see what happens. On the 4-hour chart, though, for July beans, which is where I think, if I was to play reownership strategies or pick new crop, old crop right now, I'm still seeing opportunities in December corn, full dated, that make sense, for reownership. And new crop on when you look at the chart today, held on to its gains far better than that July corn. And there's, I think, reason there's reasons, right, that is occurring, right? The weather, I think, here is much more of a new crop issue. And like we said, or like we've talked about in the past, demand right now in the short term has been kind of abysmal. So leaving maybe a little more old crop there than we thought. But the market seems to be very focused on weather and the trends that is going to unfold. So it's much easier for the market to bid December corn right now than July corn in that perspective. But okay, anyway, July beans, that setup from 1500 down to lows at the time 1390 was a 1446 area of resistance. Traded, they went to their downside target, through that target. This is that on the 4-hour chart. This is that next continuation setup that soybeans, shorts might be looking for, and it's a same anchor new low because we already had the market trade effectively this old low to new low extension or extended short can see it here from 1385s drawn down to 1304s, 1344 trades. They go down to their negative 23.6% target. 1285 goes a little bit lower, 1270, that's fine. Same anchor, so you leave it where at 1385s, bring it down to new lows. We've now traded up into the resistance at 1328, above 41, let's just call it 42, would invalidate that 61.8 line of that pull. It also really put us, in striking distance, or basically taking out the cluster of highs from mid-May through the end of the month that led to the big sell-off below $13. So, okay, couple big reasons you'd think a key revert, or some kind of, I don't want to call it a key reversal, but some kind of important reversals happening, right? Plus, we'd be breaking above this downward sloping trend line that began and really held the trend lower at that point. There's still some other downward sloping trend lines that we'll talk about as we get up into them above, but by the time you get above, in my opinion, this 1340 area, there isn't much in the way until you get back to 1380 to 1400, the old supportive range that July beans were in, or the low end of the range that July beans were in. So you're testing old support now as resistance on the way back up there. So I would imagine that would be the next area. Look for a little bit of a fight in the next 48 hours to get above this area in 1350. But if we do get a move up there and then a steep pullback, that pullback might be the opportunity if you haven't taken one already. But at least how I see the market potentially trying to bottom. Now, again, this doesn't happen. We kind of falter. We stay below this area in the near term or go straight up to 1400 and roll over. We could still be in a bigger downtrend, but at this point, a rally up to 14, that's a $1.30 rally off of lows. I mean, that's exactly the weather premium kind of rally we're talking about. That's the one to sell into for doing cash sales and what have you, if we get up there in the near term. Could you do some here today? It's pretty aggressive. I think I'm personally, because of the weather and the other things we're seeing develop, I'm personally waiting to see if this breaks and then potentially trying to get long for a swing higher off of the first pullback you get. There's a very good chance if headlines and everything remain as they are in weather, you just don't get that pullback, right? It just kind of goes up to find resistance, and then we get violent again the second you see one rainstorm. And that's, of course, I'm talking about beans. That's probably the weather this time of year is going to affect, I think, the corn a little bit more, just because I know there's D3 corn and stuff out there that is starting to roll a little bit from what I heard from some people in Iowa. So not great. So, all right, soybeans, like I said, I think we're into resistance right now. Today, fading off of where we found highs. Not a great area. I wouldn't be surprised to see them poke their head above tonight. But again, unless they really push through, and 1341 to 1345, that's the area for, in my opinion, that once we get above, would really signal the reversal, right, on many ways on the technical chart, if it hasn't, already started. All right, let's take a look at July corn here. Daily chart has now come back up to already test the $6 figure. This is the kind of like soybeans, $14.8 or $13.80, $14 on that July, old range lows. I would say the $6 to $6.05 area is that similar level. It's being defined by a trend line against the lows that was otherwise supportive and holding kind of a wedge that then we broke below here in April. We came back up to test it again there in May as resistance. We fell down to the lows of May. We've then actually had a rally since that low up back above $6, back above that 18-day moving average, into the 55-day moving average at 605, and up into that broken trendline support now as resistance once again. So don't actually love where July corn sold off from initially, but it pulled back right back into that 18-day and 10-day moving average, which are both basically right around 580. There's also a 50% pullback from the 546 area up towards 605s. That was that 50% pullback happened, from 605 towards into the 577 low that we had, and the market rallied back up to test the highs. So We'll take a look at that short-term price action that happened between the 55-day moving average and the 18-day moving average here on the 4-hour chart. But when we take a step back, on the daily chart for July corn, from basically COVID lows for corn prices to max peak inflation of 2022, corn has pretty much done 2 massive steps forward and 1 step back on the chart. It's a 50% pullback from that swing in a big way. So is the 550 area the capitulating, low that, market can rally to new highs from? Sure. But it's going to, not necessarily in July corn, but it's going to need, to continue to see, the fundamentals to support that, which means dry conditions this year, and everything, strong demand still, and everything else that goes with it, right? That some of those things are a shift from what is currently going on. We don't have the strongest demand. It could be there now that prices, had maybe were rationing that demand at above 6. Well, maybe down here it's not anymore, but that remains to be seen. I think with sub $70 crude oil, it's very hard to make that argument again. But here we are, back to $6, and the market in July corn seems to be trying to revert back to its means. So overbought in the near term was unwound here in this kind of 2 days of sideways price action. So we technically do have room to the upside, in my opinion, on the RSI and our momentum indicators, which is good because I'd hate to see this market just sit still here during the weather events, right? If we can't get these markets excited and through, their current levels with the weather and the forecast we currently have, what good is it? All right, same kind of idea on the daily chart for December corn. COVID lows to the peak inflation highs, 2 massive steps forward. You can see that 50% area at 525. 61.8 lines here was, interestingly enough, at 489. And wouldn't you know it, on December corn, we came right down to that level. Did not go through it, completely held it and pounced. I would never have guessed that on a daily chart to the tick, right? But there it is. Similar level to the $13.80, $14 July beans, that $6-ish area on July corn, $5.50 to $5.60 on December corn is that old supportive area that we broke below here in March through April. But in the last, swing up, we have clambered back above the 18-day moving average and the 10-day moving average. Both found a support in the pullback, not overbought in the RSI. But that, 55-day moving average at 541 still seems to be kind of the resistance now, or the area we're getting sold off in front of here for December corn. I think above that high, we open the door back to 561, the 100-day moving average, and wouldn't you know it, a test of that old supportive area. Maybe now is resistance, but if we get back into it and above, that really gets bullish. So look for the 560 to 580 area as strong resistance up into that 200-day moving average as well if we get a significant rally from where we are. I mean, we're talking 30 to 50 cent rally, right? If things get really exciting, which I think in this type of environment, things have a tendency to be a little more exciting than they necessarily need to be. We probably got way too bullish on corn there, and prices here into the end of into this year. At the start this year, we had some very, very expensive bags of seed, effectively. Those premiums were taken out. Weather premiums now arguably are needing, or the chart possibly is saying they need to be built back in. And so, that pendulum swings back the other way. Downward sloping resistance and trend lines 560 to 580. There is clusters of them. We could very well be capped just by the chart alone to the upside, even without a rainstorm. But I would imagine it's probably going to correlate, finding that high and those resistance areas and weather or forecast shifting. It's probably all going to happen, in my opinion, all around the same time. But trading up on the day, 8 1/4 cents at 530 for December corn. Actually, a really good close of the day. And if I was to ignore July corn altogether, I'd say December corn looks quite bullish right now, just from the intraday price action and kind of how it's been handling itself. So we'll see. The 4-hour chart for July corn, again, closing back in yesterday's range. Doesn't take out of the question, a retest back down towards, 50% from lows to highs here from 547 low to high, 606. That was that 576 area, was that 50% area. Can't discount that we could get back down there. Interestingly enough, on the way down for corn, there wasn't much of a 50% pull until, this 567 swing down from highs, or 647 swing from the highs of April down to the lows here. Finally pulled up into the 50% area. So both sides of the market on the 4-hour chart, 50% short from the dollar swing from basically 647 to 547 lows, 50% at 597 has traded. It's kind of got a reaction. But swing from lows to highs, they're also got a reaction. So there's definitely, I think, a fight over the trend here. And certainly this inverted head and shoulders pattern, if you can already kind of identify it here with the neckline basically at highs of the month now, above 606, I think, oh, sorry here, guys. I had the wrong chart up on the screen. Let me bring it over. There we go. You can see the two fibs, right? Inverted neck and shoulders. Here's your left shoulder. Here's your head, your right shoulder. Could easily see a push down to 570 to 580, still kind of finding that right shoulder. But neckline clearly at $6 to 606. Let's go with highs of the month at 606 and highs of May at 607 and a quarter. That would be a neckline break, right? And then to the upside, just from where we were, the next resistance was up around 640. Downward sloping trend lines from 705 highs through highs. Okay, 640 would be the next logical place for July corn to the upside if it can push through, the 609 high there. So we'll see if it can do it. But not much time, right, left, but helps to have a weather market for that idea in the near term. All right, last but not least in our row crops, our wheat also kind of popping its head back above $6 here for Chicago, up 16.5 cents on the day. Back with the 10-day moving average here, first day for a close there since mid-May, basically since the last 2 weeks of selling pressure we've seen. We're, in my opinion, reversing that exact idea and maybe even reverse the trend now that we're above that 10-day moving average. 18-day moving average still above us at 622. Downward sloping trend lines against the highs. If you're familiar with Elliott wave, call this an ending diagonal perhaps, but the idea being is each push over the last several months lower has lost momentum, and eventually, right, there's a short covering rally. It doesn't need to take you back to $12, but there's certainly resistance on the way up to find. And boy, the chart of Chicago wheat, there is just start drawing lines on it, right? And you can find plenty of them. The big ones, the 100-day moving average at $7, the 55-day at $662, 18-day as I mentioned at $627. We'll talk about the 200-day up at $770 soon enough, but that is also where, right, the support from last August was, and the resistance here through the end of this 2022 and into the start of this year was, that $7.70 to $8 area. So that's a long way off to talk about. But for the time being, we seem to want to be trying to climb back up into this old range above $6, which opens the door to $6.60 to $7, in my opinion, in the near term. So watching closely, kind of like soybeans, at least Chicago wheat has reversed that 2 days of selling with 2 days of buying. We're right back to where we were last week, and now comes the moment of truth to see if bulls can kind of undo, right, what the bears had done before. They already undid the first round of selling and the new low they made. Now is the chance to undo, I think, the trend, so to speak, to some extent, at least for short covering in the near term, right? KC wheat has not been as luxurious as Chicago recently. There's been rain in some problem areas of the key Kansas growing areas, obviously. That weighed on the markets, kept us in a bit of a range here. We've been kind of in this expanding price range for some time, and that to me is just volatility picking up, which means if volatility can't break us down, and notice on this chart, we've actually started making progress of higher highs and higher lows when you consider the weekly swings for KC wheat, and that's a change. So here we have a lower low, lower high, lower low, higher high, but then lower low, lower high, lower low, right? So then you have a pattern of lower lows and lower highs going here. That changed here after we made a higher high, blew out highs going back to December, and then made a higher low here recently. Now, obviously going below 736 changes that a little bit, and here I am talking about a chart and leaving the small one there on the right. But point stands that if now the higher highs and higher lows that are happening on the daily chart, right, 1, 2, continue, well, the weekly swings are also making it. So unwinding this entire sell-off and getting back to $8.80 to $9, KC Wheat's done it a few times since January. So I don't think there's any reason it couldn't do it again. But keep in mind, right, that sellers are going to be waiting in the wings. Those that didn't get the opportunity, right, to sell earlier and often, I think in many of these markets we'll see them jumping on those opportunities. Certainly I'll be talking with my clients and trying to capitalize on those because that is, of course, the name of the game for producers. All right, other big mover here today, and there isn't much to look at, I guess, in the 4-hour charts, other for wheat and bean, or wheat and KC, and honestly, I kind of want to move into get cattle out of the way here because going into deliveries for June cattle, holy cow, right? Clearly, shortages are making their way through the industry. I think that has been a widely talked about conversation. Packer margins getting squeezed here, right, with the cost of cattle going up, and I don't believe the cost of beef and cutouts has rallied this much today. I did not check it though, but needless to say, very big rally in the cattle today. Parabolic. I mean, fairly unprecedented in terms of the move, relative to recent price action, right? Even in deferred months, right? This is not a just front month delivery thing. Even October cattle saw a big rally. Certainly we're seeing bull spreading right here. You get June to December was bull spread somewhat, suggesting back months there's going to, 200 days out into December, there's going to be some cattle coming through the pipeline, right, that they're not, we're willing to, the market's willing to assume that supplies will start to, right, build. And of course the demand here and now is what's driving, right, that price action. The fear, right, that you're not going to be able to get cattle for processing over the next however many days, right, is being figured into the market. If you look at those actual futures curves, you could probably make some pretty educated guesses as to when the futures market thinks that'll happen. But that's not a conversation for right now because I haven't had the time to sit down and look at it with more than just a few seconds before this. But I could already see there's some interesting dynamics playing out there. All right, upward sloping trend line. I mean, the market broke above its channel. At this point for cattle, I would expect to see some kind of steep pullbacks. You got to test broken resistance as support at some point. But yeah, we're into new territory for these contracts, right? These are new contract highs. We have all-time highs for certain, in certain cases. And once you get up here, it's not about where there is resistance anymore, right? It's about just when will buyers stop buying. And that's the question, I think, in the delivery for June, which has basically 3 days left on the contract here. That's going to be an interesting thing to follow. Like, is that going to top out these markets? My guess, probably, right? Whenever we see it, but it doesn't mean it can't keep squeezing. Like, the next 2 days could get absolutely brutal, particularly for the June contract, if this is any indication of the way things are going. So watch out. And I mean, there's really not much else to say. Feeder cattle were late to the party here today, but they did follow through. We're leaving all of our moving averages, in the dust. Interestingly enough, though, for September feeders, if you draw that trend line higher kind of the parabolic slope of what we're getting. You draw trend lines against the lows, and then trend lines kind of against the highs, and those ones against the highs project, where the next leg up goes. Just pointing out that, September feeders have kind of reached that area. So if I were to just say, hey, Dan, where's there a top? This is probably a good place to say, if I'm long, taking profits is not a terrible idea, right? Or trailing stops aggressively at this point to lock in those gains. Because again, we could just continue squeezing higher. This is not about where the sellers are that are going to stop the market from going higher. This is about when will buyers stop buying. And if there's funds in here just leaning into this, it will keep going until it's finished. You can see that trend line I'm talking about here on the chart for the September feeder. We'll see. And we'll talk about these moving averages as we come back down to meet them, and where, potential to hop into the trend higher still is, because this is still an uptrend, and a pullback is technically to be bought, right, in a trend. Not that I'm advocating doing that right now. It's just trends up until it's not. Although probably closer to a top than a bottom. Some of our outside markets today, like crude oil, let's not get into crude yet. Finish out a row crop or crops and cotton, because this is the last, and then we'll go into look at gold and oil real quick, and then call it a day. July cotton leading the way here with a snapback towards its high end of the range. This could just be a market trading volatility inside, 88 to 80. It's done it a few times. Having pulled back and based in the middle of the range and then going back to the high end, though, suggests that, another day or two of pressure on this high end of the range, we might just be going through into tomorrow. And a push up to 90 opens, again, the door above this range and back towards 100 to 110. Do we have the situation in the cotton acres to warrant that? I would say so. I mean, everything is getting stressed. And I know in some places, from what I've heard, there have been some concerns. So anyway, it's obviously December cotton where we're going to be wanting to see that confirmation. 84, break above that high end of the range would, I think, confirm that for me. But generally speaking, we've held the low end of the range for December cotton yet again. We have upward sloping trend lines in a couple degrees to consider here that have held. And we're right back above and trying to get back above that 18-day moving average, which today's close, I think we were just, at or just above it. I'm expecting a push towards 84. And if that's what's going to happen for December cotton, well, July cotton's probably going above 88 and towards 90. And if that's the case, and by the way, neither one of those markets are now overbought yet, because we unwound in the last week, the last rally. But both, I think, have bottled up for long enough in these ranges, and this move back up to the high end of the range is just one more chance for cotton to break out. I've been a cheerleader for a long time in these ranges for it to do that, and I still see every indication that there's an opportunity for it to occur. So paying close attention to that. And I think, again, weather markets, cotton, another one to maybe pay attention to here in the near term. All right, crude oil. Now let's talk about the light, sweet Texas crude. Daily chart, we've talked about this in the past. COVID lows to highs, max peak inflationary high. Very similar to our corn chart, right? We did two big steps forward from 2020 lows through the 2022 high and have taken one big massive step back. And if you were to think about inflation as a cycle, this is the trend of inflation that I'm opinionated on, or taking an opinion on that. We have now seen the low end of our new normal range, and we're probably going to head back towards the high end of it. There's a lot of other things that will coincide and would help, that argument. And a Fed pause and all those types of things, reducing interest rates, would help that argument a lot here. So would other, events that cause volatility, like war and conflict. There's plenty of reasons to think that there are, could be headline scares in the future, and that could go in both directions too. But in the meantime, crude took a few years to really break out of $60 a barrel, really get back above $80 a barrel. Now we've pulled back to test that area of old resistance as support, in my opinion. We have a very choppy downtrend that has been channeling lower. And now we are, while we're technically made lower lows here, the market is now diverging a little bit. This last push lower, today we've reversed yesterday's selling pressure. Like our row crops, we have a little bit higher to go for crude to take out the swing lower that we've seen. And getting back above 74 would, I think, help the argument to get back to 80 and above. And that's kind of the area in the market above 80 now. And above this high, the highs from November through March and April, around 82. That area in the market, I think above there is the real key for crude to going, higher, $100 to $150 a barrel. You want to talk about those levels? 80 to 82 is what needs to be broken, because that is, to me, the right shoulder of a head and shoulder pattern, okay? $60 area, you have to acknowledge, was very clear support April of 2021 through November of 2022. It also formulated some left shoulder structures with a big head at peak inflation in March of 2023. Russia invades Ukraine. Then we unwind basically for the next year. And we've already formulated maybe one of those right shoulder patterns at that area with that last rally through April. So below 60, we capitulate, and the next area of major support resistance I see is around the 30 to 40 area. There's many arguments to be made why that threshold has geopolitical, reasons that we find our way down there at times. But there's also geopolitical reasons why we're above 60 to that point. Back above 82 kind of negates that structure. It breaks downward sloping trend lines. It opens the door to a test of 100. And it changes the game. And again, I think we'd see headlines and other things that would drive us to that. And certainly consumer demand over this next summer, given that is the time of year where we see highest gasoline and air travel demand, we're going to see if that also weighs into it. Okay, so anyway, in the near term, 83.53 high to low, down to that 63.64. 73.59, that's a 50% short that's holding. Their downside targets are towards 58.95. All right, the 50% swing from low to high kind of went to the 61.8 line, but we'll give it a grain. We'll give it at least the idea that it could be a retest of this larger 50% area, which, by the way, has been tested a few times here and kind of holding that 50%. So can't really hang our laurels on that. And you have to at least consider now that because we broke a 61.8 line from high of 74.75 to low here, the rally we saw in crude today was right up into that 50% swing. So the high from 524 to 531 lows, June 1st started with a swing into the 70.88 high. If we see follow through to 65 and down to 58.95, well, I think you all know what I'm thinking. If we take out 72 into tomorrow, looks like a good reversal to me. Now we're talking about putting pressure on 74, this old area of resistance that we clearly already fell from. And above there, 76 negates that idea, puts pressure on the downward sloping trend line, puts pressure on the 80 to 82 area. Then we're talking about true reversal and maybe talking about a swing reversal for crude higher. Otherwise, still been in 82 to 60 range until it isn't. All right. I think crude feels very comfortable at these levels, which I don't think it will be comfortable at these levels for much longer. Gold, last but not least today, kind of continuing a bullish trend here from the lows of February at 1809 to the highs here of 2085, 50% pullback into 1950 trades, the level we talked about, broken downward sloping trend lines off the highs. It's just, in my opinion, it's the market breaking above resistance, finding a support. Trend line against the highs in the near term, right? Coming off of the highs, this downward sloping channel broke that area. I was really, really hopeful we would be getting like a 50% pullback here from 1490 up to highs. It just didn't, it almost happened there at 1470, but whatever. I think that gold now is probably back above 2000 is on its way back to 2080 to 2100, and the swing could take you up towards 2150. And at that point, now we're talking about, are we in the much larger swing, from that held at the 1600 area that could take you to 2297. Let's just call it 2300 on a swing higher for gold. Man, while we're above 1900, I've got, it's my opinion that is exactly what could be going on here. So, all right, everyone, that was a lot to cover. A lot of weather in the beginning brought the row crops together and some of the price action we're seeing. Cattle, very strong. There's fundamental reasons why we're seeing that. And into a delivery period for June and the end of life for that contract, seeing it go bonkers, I would be very cautious, right, with the long side. And in that, hey, profits that come quickly can disappear, and if this is all end of life for June, this could get very interesting very quickly in either direction. So be cautious and keep an eye out on the cattle if you're exposed or trading those markets. Have a great day, everybody. Have a great weekend. This has been the Strategy of the Day update. I'm Dan Hussey from Zaner Ag Hedge. Remember, you can always get in touch with us over here at Zaner at 312-277-0110, my number on the screen there. Shoot me an email at dhussey@zaner.com or find me right here on Facebook at Dan SOTD. Until next week, have a great day, everybody, and we will be back with you as price action develops. Take care, everyone.